So let's talk about a huge story unfolding in the global economy right now. We've got two massive, powerful forces basically on a collision course. On one side, you have this incredible, unprecedented push to use finance to build a sustainable future. And on the other, well, you've got a classic economic alarm bell that's been flashing red for years. This is a story of long-term ambition meeting short-term reality.
Okay, so let's set the stage. For a while now, there's been this absolutely monumental shift happening in the financial world. It's like finance itself has been given a new mission to take all that power, all those trillions of dollars, and point them directly at solving our biggest problems. We're talking climate change, inequality, you name it. The end goal? To build a truly sustainable global economy from the ground up.
And right there, that's the core tension we're diving into. What actually happens when this incredibly optimistic, long-term vision slams right into a deeply pessimistic, short-term economic signal? That's the conflict we're going to unpack.
First up, let's look at the good news part of this story, because it is genuinely historic. We are talking about a full-on boom in green investing that has completely reshaped how money moves around the planet.
Here's the headline number, just get a load of this. In 2024, the amount of money raised through sustainable bonds, so money specifically for green and social projects, hit a record-breaking $1.052 trillion in a single year. That is just a staggering figure.
And look, this wasn't just some one-off fluke. The growth here is just incredible. We went from under $400 billion in 2019 to over $1 trillion just a couple of years later. All told, since 2019, we're talking about more than $5 trillion in total capital raised. This is a massive, sustained shift in the markets. So you might be wondering, where is all this cash actually going? Well, the priorities are pretty clear. The biggest piece of the pie, 35%, is all about funding the energy transition. So think wind farms, solar projects, the whole 9 yards. Another big chunk, 19%, is for transport, things like electric vehicle charging stations. And 18% is for making our buildings way more energy efficient.
And the really crucial thing to remember is that these aren't just numbers on a spreadsheet. This money is having a real, tangible impact. It's literally building the wind turbines, installing the solar panels, and creating the sustainable infrastructure that we need for a global green transition. This is finance with a purpose you can actually see.
But, and you knew there was a but coming, right? That $5 trillion wave doesn't really tell the whole story. Because as all this was happening, some pretty serious cracks started to appear in that green facade, and they revealed a much more complicated picture.
The United Nations Conference on Trade and Development, UNCTD for short, they really nailed it in their 2025 report. They looked at the whole market and called it a mixed picture. Because, yeah, the bond market was on fire, but other parts of the sustainable finance world, they were really starting to struggle.
And this number, wow, this is the other side of the coin. While those sustainable bonds were flying off the shelves, the net amount of money going into sustainable funds, the kind of ESG mutual funds that everyday people invest in, it absolutely plummeted, down 45% year on year. Investors were hitting the brakes hard.
So what happened? Why the sudden cold feet? Well, it's a mix of things, really. You've got a political backlash against ESG in some places, particularly in the US. You have higher interest rates, which make those huge, expensive renewable energy projects a lot harder to get off the ground. Frankly, some of these strategies just didn't make as much money as people hoped. And a really big one, investors are getting way more worried about greenwashing. Companies saying all the right things without actually doing the hard work.
And this skepticism is having real consequences. For example, there's a specific kind of bond called a sustainability-linked bond, or SLB. It's different from a green bond, where the money has to be used for a green project. With an SLB, the company just promises to meet some goals, and if they do, they get a better interest rate. Well, investors started looking at those goals and thinking, hey, that's not very ambitious. And just like that, issuance collapsed. The market is getting smarter, and it's demanding more.
Okay, so we've got a boom in one part of sustainable finance and a slowdown in another. But now we need to zoom way, way out and look at this giant economic shadow that's hanging over everything, a classic recession warning that has economists on high alert. Now, to understand this warning, we have to talk about something called the yield curve. I know, it sounds super technical, but stick with me, because the idea is actually pretty simple. All it is a line on a graph. It just shows you the interest rate you'd get for lending money to the government for different amounts of time, like for 2 years versus, say, 10 years. So normally, this curve slopes up. It makes sense, right? You should get paid a higher interest rate for locking your money away for a longer time. That's the sign of a healthy, confident economy. But every once in a while, it flips.
The whole curve inverts. Suddenly, you get paid more for a short-term loan than a long-term one. And that is a powerful, powerful signal of fear. It means investors are so nervous about the near future, they're demanding more money for that short-term risk.
And hey, don't just take my word for it. This isn't some niche economic theory. As the financial analysis site Advisor Perspectives puts it, the difference between the 10-year and 2-year bond yields, what they call the 10-2 spread, is widely considered a reliable leading indicator for recessions. When that thing goes negative, a downturn very often follows. And here's the kicker. This wasn't just a brief little blip. The yield curve first flipped all the way back in July of 2022. Now, on average, a recession tends to follow about 48 weeks later. But this signal was stubborn. It stayed negative, continuously for over 2 full years, all the way until late August 2024. That is an incredibly long and loud warning siren from the market.
All right, so now let's bring our two big stories together: the trillion-dollar green ambition and the flashing red light of economic reality.
The picture really couldn't be clearer. What we have here are two incredibly powerful and contradictory forces moving through the global economy at the exact same time. And folks, they are on a collision course.
So let's just break down the conflict one more time. On one hand, you have the long-term push. That's the $5 trillion effort to fundamentally re-engineer our economy and secure our future. And on the other hand, you have the short-term pull. That's one of the most reliable recession warnings we have, signaling deep anxiety about what's right around the corner.
And why this matters is actually pretty simple. Recessions are brutal. Money gets tight, companies and investors stop taking risks. A real economic downturn could choke off the flow of capital to all those ambitious long-term climate projects, right when they need that funding the most. It could derail progress at a really critical time.
Which leaves us with the ultimate question. The sustainable finance movement has more money and more momentum behind it than ever before in history. But has it built up enough real resilience to power through a potential economic winter? That is the multi-trillion-dollar question facing all of us today.